settlement resolves three separate investigations. First, a criminal investigation into wrongful conduct related to the millions of unauthorized and fraudulent accounts opened for customers, including the making of false entries in bank records and identity theft. Two, a civil investigation, also conducted by the Justice Department, into false bank records that violated the Financial Institutions Reform, Recovery, and Enforcement Act, known as FIREA. And three, an SEC investigation into securities violations. I'm going to discuss the criminal and civil resolutions, and Ms. Avakian will discuss the SEC settlement. As part of the settlement, United States Attorney's offices in Los Angeles and North Carolina have entered into a deferred prosecution agreement with Wells Fargo. As long as the bank abides by a series of conditions over the next 3 years, the government has agreed not to file criminal charges against the bank and its parent company. The conditions being imposed on Wells Fargo include cooperating with the government's ongoing investigations into its sales practices and providing information with respect to other conduct as requested by the government. In short, the bank must provide its full cooperation for the next 3 years. We agreed to the deferred prosecution after considering a number of factors, including Wells Fargo's past and ongoing cooperation in the investigation, remedial actions already taken by Wells Fargo, such as significant changes to its upper management, including a new CEO, a new head of the community bank, and a new chief operating officer, chief auditor, general counsel, and chief risk officer, as well as a reconstituted board of directors. Wells Fargo's enhancement of its compliance program, internal controls, and corporate risk function, the bank's efforts to identify and compensate customers who were victimized, for example, by suffering harm to their credit ratings or being subject to improper fees, and Wells Fargo's complete admission of wrongdoing and acceptance of responsibility. Underpinning the deferred prosecution agreement and the settlement in the civil FIREA matter is a robust statement of facts in which Wells Fargo admitted its unethical and illegal conduct. Wells Fargo has admitted that the unlawful practices were driven by unrealistic sales goals and institutional pressure on employees to open new accounts for customers. Community bank employees opened millions of accounts through unauthorized or fraudulent means, and employees opened millions of additional accounts that, while authorized, were not needed by customers, were not used, and were inconsistent with representations made to investors. As a result of the wrongful sales practices, which went on for years, Wells Fargo earned millions of dollars in fees and interest that it should not have collected. It misused customers' personal information and identities, and the credit rating of some of its customers was harmed. In order to open the unauthorized accounts, Wells Fargo employees sometimes engaged in fraudulent practices known inside the bank as gaming. These gaming strategies included using customer identities without the customer's knowledge to open new accounts, forging customer signatures, a practice called simulated funding, which meant moving money from a legitimate account to an unauthorized account without the customer's consent, and altering contact information to prevent the customers from learning that a new account had been opened in the customer's name. Top management at the community bank was well aware of these gaming practices. In fact, more than a decade before the practice ended, one internal investigator termed it a, quote, growing plague. But even with the pervasive illegal conduct being known to leadership at the community bank, they refused to change the unrealistic sales model and goals, and they blamed problems on rogue employees. This case is a prime example of what happens when a company pressures employees to meet unrealistic sales goals and illustrates a complete and total failure of leadership at multiple levels within the bank. Simply put, Wells Fargo traded its hard-earned reputation for short-term profits and harmed untold numbers of customers along the way. We are hopeful that this $3 billion penalty, along with the personnel and structural changes at Wells Fargo, will ensure that such conduct will not reoccur and that Wells Fargo has turned a corner. But if not, we will be watching and remain ready to take additional action if necessary. I want to thank everyone who has played a role in the intensive multi-year investigation that resulted in the settlement with Wells Fargo. In particular, I want to single out AUSA's Ben Kingsley, Tom Stout, Ellen London, Alexander Schwab, Carolyn Small, Abe Meltzer, Dan Ryan, and DOJ attorneys Jamie Yavelberg and Mary Chris Doby for their tireless efforts to make this resolution possible and hold the bank to account. I also want to recognize the Federal Bureau of Investigation, the Federal Deposit Insurance Corporation, Office of Inspector General, the Federal Housing Finance Agency, Office of Inspector General, the Office of Inspector General for the Board of Governors of the Federal Reserve System, and the Consumer Financial Protection Bureau, and the United States Postal Inspection Service. Without the hard work of these prosecutors and agents, this resolution would not have been possible. Finally, I want to thank the SEC for their partnership and contribution to this investigation and resolution. At this time, I'd like to introduce to you Andrew Murray, the U.S. Attorney for the Western District of North Carolina.
Thank you, U.S. Attorney Hanna, for the introduction and hosting today's event. I will be brief in these remarks. As you know, Charlotte is a major banking center on the East Coast, and many national and regional banks are headquartered or have a significant presence in our city. I flew into LA this morning to attend this press event because I wanted to deliver a message in person to Wells Fargo and to other financial institutions doing business in Charlotte and elsewhere. When a reputable institution like Wells Fargo caves to the pernicious forces of greed and puts its own interests ahead of those of the customers it claims to serve, we will not sit by idle. No institution is too big, too powerful, or too well known to escape appropriate enforcement action by the Justice Department when it engages in improper conduct. Today's announcement and its significant monetary penalty goes far beyond the cost of doing business, not only because of the substantial amount of the financial penalty, but more importantly because it holds Wells Fargo accountable for all the wrongdoings the bank and its employees committed in connection with the improper sales conduct that went on for over a decade. The settlement is appropriate given the size, scope, and duration of the wrongdoing at issue, which was known to, if not encouraged by, the highest levels within Wells Fargo leadership. As U.S. Attorney Hanna said, Wells Fargo cooperated with our investigation and will continue to cooperate as necessary. More importantly, Wells Fargo has admitted to and accepted responsibility for a series of consequential failures. A failure to fix a broken sales planning process that led to unscrupulous and in many cases criminal sales practices which were so rampant, Wells Fargo began investigations into more than 23,000 of its own employees. A failure to disclose its misconduct to investors, and perhaps, most importantly, a failure to properly serve millions of customers in Charlotte, in Los Angeles, and throughout the country who trusted the bank to safeguard their money, their interests, and their personal information. Let me take this opportunity to send a clear message to financial institutions everywhere. If you put greed above customers, if you put profit above the health of the American economy, and if you think you are beyond the government's reach, know that we are here. We are vigilantly standing the watch, and we will tirelessly investigate and hold you accountable for your corruptive behavior on behalf of the American people. Today's announcement is also a testament to the extraordinary cooperation and coordination that exists between U.S. attorneys' offices across the country, the Justice Department, the SEC, our law enforcement partners, and our regulatory agencies. Our work is thorough, meticulous, and diligent, but more importantly, we work together to leverage our diverse capabilities and to ferret out wrongdoing wherever it may occur. From the Golden Gate Bridge of San Francisco in the west, to the skyscrapers of the Queen City in the east, to the sprawling local branches that connect the diverse regions of our country from coast to coast. As I stand here today next to our federal partners, I would be remiss if I didn't echo U.S. Attorney Hanna's comments about all the dedicated men and women who have worked so hard to bring about this momentous resolution, and to thank them for their commitment to doing the job they were tasked with, the job the public expects and needs us to do, to protect the interests and rights of the American people, and most importantly, to seek justice on their behalf and to do so with fairness, integrity, and excellence. To that end, I think we can all be proud of the manner in which these public servants and their colleagues carry out that mission every day. The American public should take solace in the fact that we have their backs. Thank you for the privilege of protecting your interests and your rights. Next, you will hear from Stephanie Avakian, Co-Director, Enforcement of the Securities and Exchange Commission. Stephanie?
Thanks very much. Thank you. Today, the SEC announced fraud charges against Wells Fargo and Company for misleading investors about the success of what it told the market was its core business strategy. The company agreed to settle the charges and was ordered by the SEC to pay a penalty of $500 million. Consistent with the SEC's mandate, our action is focused on the protection of investors. The investors in this case, who are distinct from Wells Fargo's customers, are those who purchased or sold Wells Fargo stock while Wells Fargo's disclosures were materially misleading. The $500 million penalty will be distributed to these harmed investors. For years, Wells Fargo defrauded its investors by failing to disclose how the pervasive sales practices fraud described by U.S. Attorney Hanna overstated Wells Fargo's successes. At the crux of the SEC's fraud case are Wells Fargo's repeated misrepresentations to investors, including misrepresentations about an important metric for its largest business segment. This metric was known as cross-sell and was presented as a measure of Wells Fargo's success at executing on its cross-sell strategy. That strategy was to sell to existing customers additional financial products that those customers needed. Wells Fargo told investors that its success at cross-selling was a competitive advantage for the company and key to its ability to grow revenue and earnings. During investor presentations and analyst conferences, Wells Fargo characterized this strategy as central to its success and routinely discussed its efforts to achieve cross-sell growth. By doing so, Wells Fargo sought to induce investors' continued reliance on the cross-sell metric, pointing to the metric as proof of success. In reality, for years, Wells Fargo misled investors by falsely presenting the cross-sell metric, including in its filings with the Commission, its annual reports, and in presentations to investors. Wells Fargo's community bank employees opened millions of accounts or financial products that were unauthorized or fraudulent, and they pushed products on customers that they did not need and would not use. These unauthorized, unneeded, and unused accounts and products inflated the cross-sell metric. Yet, Wells Fargo continued to falsely portray the cross-sell metric as a measure of its ability to successfully cross-sell needs-based products to existing clients. Rather than tell investors the truth that the cross-sell metric was inflated, Wells Fargo touted the cross-sell metric as it increased. Then later, when that metric began to drop and suggest that product sales growth was stalling, Wells Fargo continued to mislead investors. When asked about a decline in cross-sell growth, instead of acknowledging the fact of the sales practice misconduct and that efforts to address that misconduct were part of the reason product sales growth had declined, Wells Fargo did not come clean. Instead, it continued to mislead investors with its responses. This pervasive misconduct was ultimately revealed in September 2016, and after that, Wells Fargo stock dropped significantly, wiping out billions of dollars of shareholder value. The Commission found that Wells Fargo engaged in fraud by making misleading statements in its communications to investors, and in its periodic filings with the Commission. To resolve this matter, Wells Fargo has been ordered by the SEC to pay a $500 million civil penalty, which the SEC will return to harmed investors. This penalty reflects the seriousness and significance of the misconduct. Now I'd like to recognize the Division of Enforcement team that investigated the case. They are Victor Hong, John Resigno, Jason Lee, Susan Lamarca, John Hahn, and Aaron Wilk, and they were supervised by Monique Winkler. All are in the Commission's San Francisco Regional Office. And finally, I too would like to thank the many law enforcement colleagues with whom we worked on this matter. In particular, thanks to Nick Hanna and all of his colleagues in the U.S. Attorney's Office for the Central District of California, and to U.S. Attorney Andrew Murray and his colleagues in the U.S. Attorney's Office for the Western District of North Carolina. We'd also like to thank Jamie Yavelberg and her colleagues from the Civil Division of the Department of Justice, Sid Patel and his colleagues from the Federal Bureau of Investigation, Mark Hodges and his colleagues from the U.S. Postal Inspection Service. Thanks very much.
As the SEC said, the SEC money that is allocated to the SEC will be going to investors. The $2.5 billion will go to the United States Treasury. Other questions? Yes. The total settlement value is $3 billion, of which $500 million has been allocated for the SEC settlement. We took a look in determining the appropriate penalty amount. We looked at the fines and remedies and penalties available under the various statutes. We looked at the course and scope of the conduct. We looked at the remediation that the bank has undertaken, including the structural changes, the personnel changes, and also took into account the bank's cooperation, both past and ongoing cooperation. And I'm not at liberty to talk about who helped the investigation, other than to say that the bank cooperated with our investigation. Great. Anything else?
Is the DOJ considering individual charges against any of the former executives?
Yeah, I can't speak to any additional charges or other investigations other than to note that this resolution is with respect to the bank only, and our investigation is ongoing and continuing. Can't speak to anything outside the four corners of what's in the statement of facts. So, great. Thank you all very much. We appreciate it.